Hello and welcome to Apex Capital. So today in this video we will be taking a look at the different defense related stocks in the US equity market. So as you all must be aware already, the geopolitical scenario as of today is very tense, and there are multiple conflicts going all around the world. From the Russia-Ukraine conflict, we have conflicts in the Middle East involving Israel, Iran and the Hamas, and even in Asia we have the India-Pakistan border conflict and Indo-Chinese border conflict, and now recently we had the US-Venezuela conflict, which lasted surprisingly for a very short duration. Then, so in the current environment, there's a lot of geopolitical uncertainty, and the entire macroeconomic environment or the markets also reflect that uncertainty. So, in such a scenario, it makes sense that defense related stocks, especially the US military industrial complex, which comprises of US defense contractors like Lockheed Martin, General Dynamics, RTX Corporation, etc., might be a good investment for the coming financial year. The common denominator among all the ongoing conflicts around the world is the direct or indirect involvement of the US military, right? Like they might be involved directly in the conflict, or they might be indirectly involved via the supply of ammunitions to one or the other side. So be it any conflict, you will find that the US military industrial complex finds a way to benefit out from it, right? So I mean, it makes sense to have these companies in your portfolio, because I feel in the coming 1 or 2 year period they might generate good returns. So let's start our analysis, and first of all we will take a look at the past performance of these companies as such, to just to get a uh, good starting basis. So for the past year, Lockheed Martin has generated a return of 12%, General Dynamics has given a return of 36%, Northrop Grumman has given a return of about 30%, and RTX has given a return of about 63%, and the Boeing Company has also generated a return of about 33%. So there is no doubt that all of these, except maybe Lockheed Martin, have generated exceptional returns for the past year. Right? I think the Russia-Ukraine conflict and the Israel-Iran conflict has had a big role to play in this appreciation. Anyways, I forgot to discuss this. Okay, so recently also the president of the United States announced the increase in their spending for the increase in their military budget. Right, it previously stood at about $1 trillion, but now they are planning to raise it to $1.5 trillion from the financial year 2027. Now that's a very significant increase, $500 billion increase in just 1 year. That's a 50% increase in the military spending of the US government. So that will also play out as a significant tailwind for the defense contractors of the US government. So that was also a big reason why I was interested in investing in this sector, right? So here's a list of the top 100 defense contractors as of 2025, and as you can see, Lockheed Martin, RTX Corporation, Northrop Grumman, General Dynamics, and the Boeing Company. These are the top 5 defense contractors, or also known as the defense manufacturers for the US government. Now, only 3 out of these 5 are pure play defense stocks, right? Because RTX Corporation and the Boeing Company only derive about 50% of their revenues from defense manufacturing. Rest 50% of their revenue comes from unrelated sectors. Like for the Boeing Company, it's from the manufacturing of commercial airplanes, and similarly for RTX Corporation, the rest 50% of their non-defense revenue comes from uh, manufacturing jet engines via their subsidiaries, or aviation systems, and etc. Right? So only 50% of their total revenue is from the US government's defense contracts. But for Lockheed Martin, Northrop Grumman, and General Dynamics, these are pure play defense stocks, and almost 90 to 95% of their revenue comes from the US government's military spending. Right? So I think these will be the stocks we will be more tempted to buy in the current as per our current thesis. So let's take a look at the financials, right? So we go to statistics, then we can see that is Lockheed Martin is currently valued at a PE ratio of about 27.74 and a price to sales ratio of 1.58. So that's a decent valuation. General Dynamics, on the other hand, is valued at a PE ratio of 22.4 and a price to sales ratio of 1.83. So it is also more or less on the same lines. Northrop Grumman is valued at a PE ratio of 20.71 and a PS ratio of 2. RTX is a bit richly valued, if I'm not wrong. So RTX Corporation is valued at a price to earnings ratio of 38.13 and a price to sales ratio of almost touching 3, right? So that's an interesting. RTX Corporation is the one of the most expensive stocks out of these 5 stocks which we are talking about. The Boeing Company uh, price to earnings ratio is not available because they are reporting net losses for the past few financial years, right? That's why I'm not much interested in investing on the Boeing Company. It's not that it's a bad stock in any ways, but their total revenue and the net income fluctuates a lot year over year, right? Because I guess that's just the nature of the airline manufacturing industry, right? So if we take a look at their annual financial statement, so you can see that their net income varies from minus 12 billion in some year to minus 4 billion, minus 2. They have been making net loss for like past 5 or 6 financial years. So that's a very significant duration, right? And even their total revenue fluctuates a lot. For some year they might have a 25% decline, and another year they might have a 17% uh, growth in the revenues. So a lot of fluctuation. So it's hard to predict the course of the company. That's why I'm not particularly interested in investing in the Boeing company stock, right? You can invest really if you do your own due diligence, but I am not particularly interested. So we will keep it out of our discussion and we will limit our discussion to these 4 defense manufacturers. Even in these 4, RTX Corporation is a bit richly priced, so I'm not really tempted to buy their stock. Anyways, we should also take a look at their EV to EBITDA ratios. For Lockheed Martin, it stands at about 17. For General Dynamics, EV to EBITDA ratio is at about 16. Northrop Grumman, it has stands at again 17.5. RTX is again a bit expensive at 22.3. So RTX is the most expensive out of these 4 or 5 stocks which we are looking at, right? Now, General Dynamics and Northrop Grumman are on the cheaper side. Lockheed Martin is sort of in the middle, and RTX Corporation is the one which is valued at a premium. Now let's take a look at their earnings growth for the past few years. Okay, so Lockheed Martin has shown their revenue growth in low to middle single digits, while General Dynamics, they have given good growth, right? So they have given double digit growth year on year for the past okay even they okay so they are giving high single digit growth as well, like higher than Lockheed Martin, although not that high. Northrop Grumman, again low single digit growth for the most part. I mean, there was a year of degrowth, and there also have been 13, 15, 12%, 8% growth for the past years. So among these, General Dynamics seems to have uh, slightly higher growth compared to Northrop and Lockheed Martin. RTX Corporation, okay, RTX Corporation had given a significant growth in their revenue in 2024. I guess that is the reason why they are priced at a significant premium compared to these 3 companies, right? They have given 17% growth in their revenues in 2024. Northrop Grumman has a drop in their revenue for the trailing 12 months. General Dynamics have given a good growth in their trailing 12 months as well, right, compared to the 2024. For the past 12 months, 51.5 billion of revenues. So in terms of revenue growth, General Dynamics seems to be the best, and even from a valuation point of view, they are valued at relatively cheaply compared to Lockheed Martin. And RTX is, as we already talked about, they are trading at a significant premium compared to all these three stocks, right? Then in terms of return ratios, profitability ratios, return on capital is sort of low for RTX. Then their EBITDA margin, operating margin is around 11% and EBITDA margin is 15.8%. Northrop Grumman, okay, return on capital is about 12.5%. For RTX it was 6.4%. I don't know why the return on capital is so low. How are they calculating it? Net income, total invested capital, right? Yeah, I mean, it's surprisingly low. 6.4% is a very low return for a company that is valued at a PE of 38. Right, Northrop Grumman has decent return on invested capital. Operating margin is almost 12% and EBITDA margin is 15.5%. All right, no problem. Then General Dynamics has a ROIC of 13% and operating margin of 10.3%, EBITDA margin 12%. So their EBITDA margin is low, although more important than EBITDA margin I feel is the operating margin, since EBITDA margin has an added effect of depreciation. So if the company has a lot of assets on their balance sheet, they will also have a high depreciation expense. And if the company has high depreciation expense, this means they will also have a higher EBITDA margin relative to the operating margins. So we should compare based on operating margin, not on the basis of EBITDA margin if we have the EBIT margin, right? So operating margin or the EBIT margin is 10.3%. For Northrop it was 12%, for RTX 11%. For Lockheed Martin, the operating margin stands at 12% and the ROIC is at 15.8%. Interesting. So again, I don't RTX seems to be a bit too expensive for my liking. Again, I will remove it from the discussion. Now we will limit our discussion to these three companies itself, right? Lockheed Martin, General Dynamics, Northrop. Boeing Company, loss-making company. We don't want to enter at current prices. You never know what sort of earnings they will have next quarter or next year. So it's too much of a risk. RTX Corporation is a good company, no doubt, but they're already trading at a significant premium. So investing in them is a bit risky, right? All right, now let's take a look at their revenue mix. So I asked Croc to analyze these defense contractors and give me a revenue mix of, like, from which segment do they derive what sort of revenue. So this was what I got. So Lockheed Martin, leading aerospace defense contractor specializing in advanced technology systems with focus on aircraft, missiles, and space solutions. That's their primary focus. Fighter jets like F-35, F-22, and transport aircrafts like C-130 for the military. That's almost like 40% of the revenue. Rest of the revenue comes from multiple verticals like missiles, helicopters, radar and mission systems, satellite launch vehicles, etc. Right, so their primary focus is on fighter jets and transport aircrafts, helicopters, and radars. General Dynamics has a fairly diversified revenue segments. They submarines, combat vehicles, so they are providing tanks and armored vehicles, ammunitions for the uh, army. Then they are also providing submarines and surface ships, naval repair systems for the navy, and they aren't involved in fighter jet manufacturing, but they do own the Gulfstream brand. So it's a brand of business jets, right? So they are involved in manufacturing of business jets. So that's an interesting segment. RTX, on the other hand, again, RTX is a fairly diversified revenue verticals as well. They own these three subsidiaries: RTX, Collins Aerospace, Pratt and Whitney, and Raytheon. So Collins Aerospace is involved in aircraft interiors, avionics, flight controls. Pratt and Whitney, jet engines. Right. This is totally a commercial. Like, this is a big chunk of their non-defense revenue. Right. Manufacturing of jet engines, and Raytheon is basically their defense arm, which manufactures missiles, radars, and defense systems. So this was quite extensively used in the Russia-Ukraine conflict, and that was a big reason why Raytheon Technologies stock was has seen significant uptick in the past few years, because these Patriot missile system and defense system were used extensively in the Ukraine-Russia conflict, right? Similarly, Boeing Airlines, we talked about, their 50% of the revenue comes from commercial jet manufacturing. Remaining 50% is from military aircraft and maintenance, training, logistics for the US military. Interesting. Finally, Northrop Grumman. Uh, they manufacture B-21 bombers, okay, and they're also involved in manufacturing of components for F-35. Then they have sensors, radar systems, missiles, munitions, satellite launch vehicles. So again, they also have a very diversified portfolio. All right. So basically, this is the picture which we have in front of us. Uh, so as we talked about, Boeing Company is already out of our discussion. RTX Corporation also seems a bit on the expensive side. Among these three, all any three of these are good. I mean, it's hard to pick one stock to invest in, but I personally like General Dynamics because it seems to be the cheapest out of the bunch, and also has shown good quarterly growth over the past few quarters, if you notice, right? So double digit growth over the past few quarters, and annual growth is also a bit higher compared to Northrop Grumman and Lockheed Martin. So I personally like General Dynamics, although Northrop Grumman, General Dynamics, Lockheed Martin, all three are good companies to invest in for the long term, with the 1 to 2 year horizon at the back of your mind, right? So Lockheed Martin revenue growth is somewhat lagging on a quarterly basis. Even on an annual basis, it is in the low single digits. Northrop Grumman quarterly growth is, again, it is in the low to mid single digit growth, and on an annual basis, it is mid to high single digits. On quarterly basis, it feels a bit low. General Dynamics is showing good growth in revenue all around, and they're also able to maintain good margins. So for me personally, I think the highest allocation would be for General Dynamics, and I would also add small quantities of maybe Northrop Grumman and Lockheed Martin as well, right? So all right, so that completes the discussion for this video. Thanks for watching, and see you in the next one.